how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. So that was 06-07. It was a harbinger of the tech and telecom bust in 97-98. And in 1969-70, it was the harbinger of a recession.
The brilliant founder, CEO, and CIO of ARK Invest, Cathie Wood, takes us on an exploration of the ever-changing world of global finance and innovation in the most recent interview of her insightful monthly broadcast. Cathie explains the profound changes caused by monetary policies adopted by governments, helping us to navigate through these uncertain times and move on into an exciting but challenging future. Alongside Yassine El-Mandra, the renowned director of digital assets at ARK Invest, Cathie explores the specifics of the Bitcoin halving, utilizing her insightful observation of trends and innovative technology. They examine the importance of Bitcoin's mathematically sound monetary policy and compare it with the unpredictable actions of central banks throughout the world. Amidst the uncertainty, Cathie cautions against a potential financial crisis, similar of previous financial crises, and highlights the dangers of the Federal Reserve's present position on inflation. She draws comparisons between previous financial booms and recessions, and stresses the need for quick action to prevent another global financial meltdown. Let's hear her following words.
This halving chart is, you can see the discipline here as Yassine said, it's been mathematically metered, and actually we did a Bitcoin brainstorm with miners, and I think Yassine's going to tee that up in a minute. But this monetary policy basically was written in 5 lines of code. I did not know that until we did that Bitcoin brainstorm. It is so elegant, so simple, so straightforward. So in contrast, take a look at this. All right, this is M2's M2 growth, and it's a 4-year annualized percent change. So from March this month to March, or this past March to March 4 years ago, what is the monetary growth rate at an annual rate? That would be the last data point here, which is, you can see the black dash line. So that rate is about 8%. And actually, probably it's closer to 6%. There's a lot of data on this chart. But take a look at the 4-year growth rate of M2, and you can see it's all over the place. You can see in the 60s and 70s, it moved toward double digits, and we ended up with double-digit inflation in the late 70s, early 80s. It took a while to get there, and it seemed to be very sticky. And then after Chairman Volcker came onto the scene, I think that was 1979, he said, we have to get this thing under control. And he started choking money supply. And that momentum actually continued into the mid-90s. And then in the mid-90s, it's very interesting because it's somewhat similar to today. In the mid-90s, there was a domino effect of currency devaluations around the world. Our monetary policy was propagating throughout the world because it is the world's reserve asset. And the first devaluation actually was Mexico. And it was a big one. I remember it very clearly because we were involved with Mexican stocks. And then a few years later, we had the Asian domino effect. I think the Thai baht devalued in 1997, and then the rest of Asia's currencies devalued. We had the Russian default in 1998, and then we had long-term capital falling apart. Monetary policy propagates through the system, and when it's so unpredictable, it leads to all kinds of excesses. And so what do we have now, where we see what happened because of COVID? That drove the 4-year annualized growth in M2 up to 12%. And then now we've had a very sharp deceleration. Unlike the 70s, 60s and 70s, where there was sort of an acceleration, at least in the sense of a trend, and a stabilization near double digits. Here we had money thrown at the system to prevent an outright depression. And if by the end of the year we stabilize around 0% year-over-year growth, that's year-over-year, this line will drop toward 2 to 3%, which, as you can see, we've only seen once. It was in the 90s, and after that, all hell broke loose around the world.
Cathie Wood warns against the Federal Reserve's relentless insistence on keeping interest rates high, which is escalating the problems facing already vulnerable economies. At least 3 currencies have had severe devaluations of 40-60% versus the US dollar in the last year alone. For example, continuous devaluations since early 2022 have caused the Egyptian pound to lose an astounding 2/3 of its value in relation to the US dollar. These devaluations have been compounded by an increasing lack of foreign cash. Both the Argentine peso and the Nigerian naira have seen significant devaluations in recent months, making the situation for both currencies equally bad. Fortunately, those in these areas who have access to the internet may purchase insurance in Bitcoin and take safety. Millions of people in developing nations now rely on this to keep them alive as their fiat currencies gradually fall. Furthermore, wealthy economies are not safe from the impending storm. Cathie suggests that things are about to become worse and warns of approaching chaos. Let's hear Cathie following words.
We're in a very interesting environment, and it's caused by monetary instability around the world. And so I often talk to Yassine about these devaluations. And of course, in emerging markets, anyone with a connection to the internet now pretty much can establish or buy an insurance policy in the form of Bitcoin, which, just flipping back to the halving in this purple line, doesn't look anything like the volatility you see in monetary policy here in the United States and around the world. And of course, it's controlled by human beings. When we went off the gold exchange standard and closed the gold window in the United States in 1971, monetary policy just became unhinged, and it has been unhinged ever since, although human beings have tried to contain the inflationary ramifications, and they take it too far both ways. And right now, we think they're taking it too far on the downside. Here's the real Fed funds rate. So the Fed funds rate is roughly 5.5% and 5 to 5.5%. And you can see the minus 3% gets us to 2.5% there. If inflation does come down the way we expect, and the Fed does not cut rates, which the markets now don't expect one until November, if they don't cut as inflation's coming down, then this line is going to go out closer to 5%. Again, we haven't seen that really since the 80s, when inflation was still considered embedded or at risk of going back to double digits. We're nothing like that today. On the next page, this slide is how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. So that was 06-07. It was a harbinger of the tech and telecom bust in 97-98. And in 1969-70, it was the harbinger of a recession. Just a quick note on fiscal policy. You can see the deficit. We present this each time, and just want to reinforce that the antidote to this deficit, which in a so-called expansion is at 6.5%, that really has not happened except in the aftermath of the 08-09 meltdown, while stimulus was still flowing freely in response to it. But we're not in such a meltdown now, and we do believe growth is going to be the solution, as it was in the 90s. You can see the 90s in the Clinton administration for the most part. We ended up back in a surplus, which was a function of the very good growth.
With a focus on the fundamental causes of the world's financial instability, Cathie Wood offers a thorough examination of the state of the economy today. Monetary instability is an important topic in her talk, which she provides to the unpredictable policies pursued by central banks around the globe. Currency devaluations are a major issue that Cathie discusses, and they are especially noticeable in emerging markets. She cites examples where the value of currencies has declined sharply compared to the US dollar, leaving economies susceptible to greater volatility. These currencies include the Argentine peso, the Nigerian naira, and the Egyptian pound. In midst of these obstacles, Cathie suggests that those looking to safeguard their riches may find some comfort in Bitcoin. Because it is easily accessible through internet connectivity, Bitcoin may be used as a safe haven against the depreciation of fiat money, providing some stability and security during unpredictable times. Cathie highlights the significance of introducing more sustainable methods of economic management by drawing a contrast between the unpredictable nature of old monetary policies and the regulated issue of Bitcoin through its halving mechanism. She draws attention to the dangers of excessive central bank tightening, which may result in interest rates that haven't been seen since the 1980s and pose serious risks to inflation. In addition, Cathie highlights how crucial it is to promote stable economic development in order to reduce budget deficits. She compares the surplus attained under the Clinton administration in the 1990s to policies that emphasize long-term prosperity as opposed to merely increasing government spending.